Welcome back, my friends. As you probably already know, consumer demand is weakening. The United States is teetering on the brink of recession. And consumers are pulling back on spending. This is hurting the shipping companies. And now, we are hearing reports that FedEx has declining shipping volume. They are parking planes and cutting back on flights. Especially international flights. This video continues our coverage of the financial events affecting the economy. What does it mean for the US economy? What it means for Wall Street? What it means for the job market? And what it means for the future of the United States. But before we get into that, hit the like button and leave a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos. FedEx said that it plans to cut daily international flights across the Atlantic, the Pacific, and between Asia and Europe. Shipping volumes are down recently, and FedEx needs to align its cost structure with this declining worldwide demand. FedEx plans to cut 11% of its flights across the Pacific. 9% of its flights across the Atlantic will be cut, and 17% of its cargo flights between Asia and Europe will be cut. FedEx held its quarterly earnings call yesterday, and news of the flight cuts were announced to Wall Street analysts during the call. FedEx basically stunned everyone last Thursday when it pre-announced very weak quarterly results. The centerpiece was a more than $600 million year-over-year decline in net operating income at FedEx Express. FedEx Express is the division for air and international operations fall under. We cannot cut the unit's costs fast enough to offset the dramatic volume decline out of Asia Pacific and Europe, said FedEx in the earnings call. The flight reductions and their financial impact will start in November, FedEx said. According to FedEx management, service levels will not be impacted. And no pilots will be furloughed. It was a very tense and somber earnings call, to say the least. In keeping with popular practice these days, FedEx blamed the usual whipping boy, weak macroeconomic conditions. According to FedEx, its customers missed their own shipping forecasts. That means that demand from their customers basically fell off a cliff during Q3. This is a market trend, not a FedEx trend, said FedEx Vice President Brie Carriere. Everyone is being impacted by the slowdown in demand, said Carriere. We are also plagued by ongoing network integration issues in Europe, Carriere continued. If you recall, FedEx bought TNT Express in 2016. And the integration of the two companies has been difficult and is not yet fully complete. FedEx finished completing the integration of the physical networks in March. But the system for hitting time-definite delivery targets across country borders still does not work very well. As you all know, the United States is teetering on the brink of recession. The pandemic affected supply chains dramatically, especially international shipping. The US government urged companies to reshore their supply chains. So, international shipping has been negatively impacted. And macroeconomic weakness is expected for the rest of its fiscal year. Someone will need to report this news to Santa Claus so he does not try to outsource any shipping to FedEx. As you also probably know, Wall Street investor sentiment has changed dramatically this year. Wall Street analysts have basically stopped valuing promised future growth. They want to see profits and earnings in the here and now. That is something Warren Buffett has been preaching for a long time. And you can see how shares of Berkshire Hathaway have held up well while Meta, Netflix, and crypto have basically tanked. FedEx has abandoned their promised growth initiatives and instituted cost-cutting and margin protection. During its earnings call yesterday, FedEx announced a plan to cut $2.5 billion in costs during the current fiscal year. And they are promising to cut an additional $4 billion in costs during the next 2 fiscal years. The international flight reductions are part of the cost containment plan. FedEx also plans to park an unspecified number of planes. The capacity decline due to the parking of planes is the equivalent of 8 narrow-body aircraft, Carriere said. Ground delivery routes in Europe will also be cut. Generally, FedEx plans to improve delivery productivity. FedEx will consolidate sorting process operations at its FedEx ground delivery unit. The Sunday delivery network will be partially cut. Various projects will be canceled or deferred. 140 FedEx office locations and 5 corporate offices will be closed. Company executives basically squirmed in their chairs during the uncomfortable Q3 earnings call. FedEx needs to re-evaluate the model it's followed for the past 20 years, said Barclays analyst Brandon Oglensky. FedEx needs to change or jettison parts of its model that have repeatedly not worked and may never work, Oglensky continued. FedEx has a clear lack of outside talent and I question whether the right people are in place to run the company, said Stephens analyst Jack Atkins. Global volumes declined as macroeconomic trends significantly worsened later in the quarter, both internationally and in the US, CEO Raj Subramaniam said in the release. While this performance is disappointing, we are aggressively accelerating cost reduction efforts, Subramanian continued. Subramaniam said, I expect the economy to enter a worldwide recession. The cost-cutting measures include the closure of 90 office locations and 5 corporate headquarters offices. The company will also implement a hiring freeze, cut employee travel, and cancel a list of unspecified projects. FedEx stock lost 12% in after-hours trading after the disastrous Q3 earnings call. FedEx reduced its plan for capital expenditure by $500 million to $6.3 billion for 2022. Management blamed economic weakness in Asia. They also blamed economic weakness in Europe for its disastrous quarterly results. While these factors choked shipping volume, the company management also blamed higher operating expenses. I tend to agree that FedEx is facing more problems than what they are owning up to. Because of supply chain reshoring, international shipping is being affected. Various new ways of getting freight around are always coming online. And FedEx has basically kept its practices static. Even Amazon is making changes to its logistics methods. And FedEx refuses to acknowledge competition from Amazon. It was only a matter of time before FedEx felt the financial pain. Remember, FedEx is a very capital-intensive business because it owns so many planes. And, given the tightness in the labor market, if it lets any pilots go, it could lose them permanently to passenger airlines. But, what do you think? Please hit the like button and leave a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.